Risk in retirement is not just market risk, it is the risk of a portfolio that no longer matches the life you are actually living. Patricia retired on schedule, all four legs in place, allocation dialed in, stability focused, cash reserves funded, withdrawal strategy set. 12 months later, the market had a strong run. Her stock position grew, and without a single intentional decision, her carefully built allocation had quietly drifted back towards moderately aggressive. She did not change anything. The market changed as she reinvested the dividends and interest on her investments. Most retirees assume that once the allocation is set at retirement, the job is done. The truth, an unmonitored portfolio in retirement drifts in both directions. A strong market run pushes it aggressive, exposing a retiree to a synchronous return risk they can no longer afford. A prolonged flat or down market leaves it too conservative, quietly losing purchasing power to inflation year after year. Neither extreme is safe, and both happen without the investor noticing until the damage is already accumulated. Here's what the rebalancing in a retirement actually protects. Rebalancing protects your withdrawal strategy. Patricia's plan calls for pulling from particular investments in a particular sequence. When allocations drift, the account she planned to draw from first may no longer hold what it was supposed to hold. Rebalancing keeps the withdrawal map accurate. Rebalancing protects your risk exposure. If stocks outperform and grow from 50% to 65% of her portfolio, she is now carrying 15% more equity risk than her plan was designed to support. This triggers sequence of return risk, the same risk we built her cash reserve to avoid. Rebalancing protects against overcaution. The opposite is just dangerous. A portfolio sitting heavy in cash and bonds in a rising inflation environment loses purchasing power every single year. Patricia is not just protecting wealth, she is growing it across 25 years plus in retirement. That requires some growth exposure, maintained intentionality, and not abandoned. The rule of thumb, review allocations at least annually. Rebalance when any asset class drifts more than 10% from its target. Retirement is not the finish line for your portfolio. It is a new phase that requires just as much active structure as the accumulation years. It's not just applied differently. I'm André. Follow for more.